Welcome everyone. Come on in. Shout out where you're calling in from in chat. I'm in Chicago. It's snowing today.
Snowing here too, Mike.
Snowing in India as well.
We got our first snow of the season. We didn't get much snow last year, actually. So this is exciting. Yeah, please shout out in chat where everyone's calling in from. London. Usually we get people from at least 4 continents. So we'll see where everyone else is. We got 2 covered. Boston. Hi, Greg. How are you? No snow yet in Boston. We got some Indianapolis. Awesome. We're going to get started here. 1 more minute and let everyone funnel on in. Denver. Awesome. Hi, Sophie. London. Berlin. Amazing. Sweden. Snow in Sweden. Very great. Well, we're really excited to kick things off. Please feel free to use the Q&A chat as we get into the content or the chat us directly. We have a team that's going to be monitoring for questions. We'll drop those in either live during the presentation as Mike and Blake get into some of the great insights that we have to share. We'll also do some Q&A here at the end once we wrap up. Very good. So let's get started. I'm gonna do some introductions, but first of all, thanks to both Mike and Blake for spending their afternoon with us here. Visible's been a proud partner of the SaaS Benchmarks survey now for the better part of 7+ years, and just super excited to continue to be a steward of the report and helping collect the data. Some of you, I'm sure, even contributed some of this data yourselves. So thanks for being a part of it. I'd first like to introduce Mike Fitzgerald and Blake Koriath. Mike is a partner at High Alpha. Mike, I'll let you introduce yourself and then let you hand it over to Blake.
Yeah, sure. First of all, Mike, thanks to you and the Visible team. We're thrilled to be here. Appreciate the partnership. And, we had over 800 respondents to the survey that actually created the report that we're going to use today and that others can read. So I'm sure many of the Visible customers and folks on the webinar were among that 800, and we really appreciate that from the SaaS community. My name is Mike Fitzgerald. I'm a co-founder and partner of High Alpha. We're a venture firm that's been invested in early stage B2B software companies for about 10 years. It's our focus and our background, and really enjoy what we do. And we invest all over the country, a little bit non-US, and happy to be part of the survey report and these valuable discussions. Turn it over to you, Blake.
Yeah, thanks, Mike, and thanks Visible for having us this morning. Excited to share a lot of the learnings from the survey. My name is Blake Koriath. I'm a partner and CFO at High Alpha. I've been in SaaS finance for the last 16 years or so of my career, and I've worked with a bunch of startups along the way as a finance professional, fractional CFO, investor, and but most importantly, for purposes of this call or conversation, as a consumer of this report. And so it's really fun to be on the other side, sharing some of the learnings, and excited for the conversation.
Awesome. Well, thank you both. Just to give the audience a quick FYI to kind of guide you where we're going to go today. We're going to cover part of the report. So we're going to make sure everyone has a link to download the full report at the end of this. We're going to cover 10 or so slides, starting with kind of the macro environment, venture activity, where the market's heading. We're going to talk about AI and vertical SaaS. It's kind of on everyone's mind. And then finally, something new to the report this year, an amazing section on founder health and wellness. I think about 70% of our audience today is founders, and we'll be talking about founder health and wellness, which is a new addition to the report this year. And for those of you that don't know me, my name is Mike Pruce. I'm the founder of Visible. We have one slide on Visible, so I won't give you the sales pitch right now. But let's get going here. Yeah, visible. Thanks again to everyone who's joined. We updated some of our stats. We work with over 5,200 founders and 590 funds every single month. Last we checked, we have customers in 147 countries. And really our mission here is just to help to equip founders and investors to thrive. So we build tools for investors to understand portfolio insights, the health of their portfolio and engaging with their founders. And we've built best-in-class tools for founders to update their current investors, help you navigate a fundraising process and track the key metrics that matter. So really in line with the entire SaaS survey that we're going to cover today. Mike or Blake, you guys want to just do one more quick deep dive on what High Alpha is? I know you guys have over $400 million currently under management, but anything else you want to give some airtime to?
Yeah, thanks, Mike. I just would highlight that we've now been doing this for 10 years. Our team is almost exclusively built from operators. So I know you said mainly founders on the line, and even though we've been doing this for 10 years, I think we still identify more as founders and operators of software companies even than we do as investors. So that's a big part of our brand and something that we hope to continue.
Awesome, great. Let's jump in. Blake, why don't you take us away? I have a couple of follow-up questions, but I'll let you take us away about who took the survey this year. I think last night I watched the recording of the first webinar you did as you announced the report. It sounds like the most ever respondents, but yeah, we'd love to have you kind of guide us through who actually took the survey this year.
Yeah, sure. Happy to, Mike. We were thrilled with the response. As you just mentioned, most respondents ever. We had over 800 respondents worldwide. And I think equally importantly, we had a wide variety of respondents to the survey. So nearly 2/3 in the US, but good representation in Europe as well. And then as far as changes from prior years, one change that we were actually quite excited about in the respondent data this year was that we had 14% more of our respondents that were CEOs or founders compared with last year. So glad that there's an audience of founders and entrepreneurs here on the call. A lot of you, thank you for answering the survey. And then also, I think importantly, from an ARR perspective, a good distribution among the various ARR bands that are reflected throughout the report. So less than $1 million, $1 to $5 million, $5 to $20, $20 to $50, and then greater than $50 million in ARR. So it gave us a really nice broad set of data across all those ARR bands, so people can compare their companies to the results.
It's awesome. One question for you, Blake. How should I think about using this data, right, as a founder or investor, right? Like it's awesome, it's great. You look at it and you're like, yeah, that's exciting. But like, should I change my business? Should I pivot? Like, how should I think about using this data as an early stage founder or investor?
Yeah, it's a great question. This is this is intended to be kind of guidelines and a map for to help you plot the right route for your company. Everybody has some nuances, some uniqueness to their own business, and so it requires some interpretation in terms of understanding what the benchmarks mean and how you can apply them to your business. We'll get into one of these maybe specifics, particulars here in a couple of slides around AI versus vertical and horizontal SaaS, and I think it'll be a good illustration of maybe a way that you can use some of the data to guide your reaction to the survey and the results. But every business is unique and different. And as a founder, CEO, someone heavily involved in the company, you know as well as anyone kind of what the opportunities are. The purpose here is to provide people with maybe broader perspective to understand what's good, where do I have some opportunities for improvement. And we like to release the survey around this time of year because we're headed into 2025 budgeting. So can act as kind of like guideposts for that process as well.
Awesome. Mike, I'm gonna put you on the spot. 13% increase here on respondents targeting enterprise, more so than in 2023. Do you have any thoughts or a thesis as to why that's happening?
Yeah, I mean, look, I think that part of it is our B2B community. I mean, this is, you know, we tend to work with companies who are pursuing the enterprise, but I think maybe even more than that, there are higher dollars to be had in the enterprise. And while it's not for every company, you know, it's pretty typical that we meet with businesses who are selling to the mid-market or even lower market, and they aspire to be in the enterprise. And I think that there will just be a pursuit for most companies to try to get up into that area. Larger contracts, things like net revenue retention and growth rate are impacted if you're selling things 10 or 50 or $100,000 at a time. So again, not for every business, but it is a pretty common pursuit for most software companies to try to sell to bigger customers.
Yeah.
Mike,
Awesome.
let me jump in too and add one more thing around this ICP part of the data. There was one question that asked respondents to pick their primary ICP, and that's what we're seeing here is what percentage of those respondents picked this as their primary ICP. There was also a question that asked them to select up to 3 that ICPs that they targeted. And while enterprise was the largest in terms of the primary ICP, mid-market was actually got the highest level of response when given the option to pick multiple different ICPs. So, you know, I think that makes sense when you think about it. You may have folks targeting the enterprise, but they're also able to move down market a little bit and sell to mid-market, or vice versa with SMB, where maybe that's their primary, but they can shift up into mid-market as well. So sometimes that can become the best of all worlds in mid-market when sales cycles might be a little quicker with slightly smaller contract sizes, or conversely with retention maybe being a little bit higher than those that are lower down the stack.
Yeah, awesome. Great. Let's move on to, excuse me. Kind of the real-time data confirming about the recent stabilization. I think this is good news. Blake or Mike, you guys want to take this one away? I got a couple of follow-up questions for you.
Yeah. Look, I think the point here is a question of what was the anomaly, right? Was the anomaly kind of 2020 to 2022, or is the anomaly now? And you know, I think that we will look back and find that period of zero interest rates and kind of the free flow of capital was the anomaly, and that where we are now, things have stabilized. You saw that drop kind of from 2022 to 2023 that's indicated on the chart, and I think that probably reflects most people's experience. What's important is that over the last probably 6 or 7 quarters that things have stabilized, and I think this is, you know, we build from here.
One question I had when I was looking at this is, okay, great, the market is stabilized, but growth rates are certainly lower than they were, call it in the anomaly, and new venture funds and capital being deployed is called back to the normal level. If I'm looking at this as an early stage founder, are the milestones now higher and harder than ever before, or are the milestones maybe similar to, call it, the pre-anomaly era, right? Like, how should I think about this in terms of like the milestones? Because I think people would say it was easier to raise during the zero interest rate era. What are the milestones like now compared in those different vintages?
Yeah, look, I think, Mike, I think the milestones from a venture firm's perspective or an early stage investor's perspective are probably the same. I think what's different is if you've started a company in the last year or two and you are approaching whatever, $500,000, $1 million in ARR, whatever kind of stage you're at, from the investor's perspective, that is very hard-earned revenue. You know, there have been no easy contracts to win in the last 18 months. And that's not really true of the period that preceded that. It's not to say those companies weren't working hard and trying to do well, but when you have zero interest rates in that period, you really have two things working in your favor. One, the venture dollars are more free flowing. There were more venture firms started in that period of time, probably than any period of time in history, especially doing early stage investing. And two, the budget dollars available, particularly if you're selling into, if you have a B2B model, those dollars, budget dollars from big companies were available to try to spend money on software. So if you fast forward to the last, call it 6 quarters, and you've achieved $500,000 or $1 million or a couple $1 million in ARR, I think that is still a great milestone around which to go raise capital. The investor scrutiny of that ARR is probably very different. Those are hard-earned contracts, and if you're winning and particularly renewing business in the last year or two, I think that is something on which most companies can go raise capital. And if you're not, it doesn't mean you're sunk, but you've still got to have some compelling story of growth to be raising capital at this stage.
That's great. Blake, before we move on, anything else that you saw you wanted to touch on as you were the main steward of pulling a lot of this data together?
Yeah, thanks, Mike. I'll just maybe add that this data that we're looking at right now reflects kind of more private company, smaller company data from ProfitWell by Paddle. The other slide that, as folks download the bigger report and are looking at this section around market stabilization, that they'll see is that we're seeing some of the same signals in the public markets as well. So Meritech does a great job of pulling together public SaaS company data and providing analysis around that. And so while we saw the same peak in 2021 and into early 2022 and then decline over the course of 2022, we have seen about 4 quarters now of revenue growth stabilization and net revenue retention stabilization among public SaaS companies. And I think as most folks on this call would likely know, that lots of times private markets and private companies are quickly following what's happening in the public markets. So I think that's just another positive signal in terms of things stabilizing.
Great. Let's talk about revenue growth, getting into something I think a lot of our audience is going to care about, which is venture capital activity, whether you're an investor or founder. It appears we've returned back to kind of the norm, and things have also kind of in a healthy way have stabilized. I'm curious, Blake or Mike, is this true across stages? Like, have things stabilized across all stages? Is later stage coming back? Like, how does this map to the stage, early versus call it later or growth stage?
Yeah, I'll take the first stab at that. And what we saw in the survey responses, Mike, was that I don't think we ever really saw a big decline in the early stage, because as Mike Fitzgerald just alluded to, there were a lot of funds raised in the peak time 2020, 2021 that I think were especially in the early stages still deploying capital that helped prop up a little bit of that activity. Where the really big decline happened, and if you go look at the past couple of years of this SaaS Benchmarks survey, it was in the Series B, Series C stages, where very few companies had raised a round within the past 12 months, according to the survey responses. We did see a bounce back, a pretty significant bounce back among Series B and Series C stage companies with the survey results this year compared to 2023. So that was certainly encouraging to see. And then also within the data, that led to some additional hiring among those companies. So definitely some positive signals in the later stage private company fundraising stats.
Yeah, Bruce, I think that one of the things for even folks at earlier stages that's important is just kind of understanding why liquidity and M&A activity and even IPO activity is important. It doesn't mean that if you're an early stage company, you have to be concerned with getting acquired or going public, but the folks who are going to invest in your company, the way their business works is that liquidity is very important. So, if you're an early stage founder and you're going out to raise a seed round or a Series A, and the venture firms from whom you're seeking that money have not experienced any liquidity in investments they may have made 5 or 10 years ago, that really does kind of clog up the system. And so paying attention to, and at least just kind of understanding that an IPO window that may be opening as we head into 25 is a positive thing, if for no other reason that it is going to put money back into the hands of LPs, and those LPs are going to put money back into venture firms, and then venture firms are going to be able to deploy that into early stage companies. And that cycle is important. And if you look in history, there are times when it kind of gets clogged up, and then there are times when it's really free flowing, and it does impact all stages of investing.
Mike, you're in M&A in your past life, so I kind of wanted to tee up this question to you. You mentioned like the IPO window. Is that directly related to M&A, and I guess related to M&A, any kind of predictions or thoughts of where that might be heading, given your previous experience or being a partner on a lot of boards of tech companies today?
Yeah. Look, I think that whether you're a pre-IPO company or a public SaaS company that's been around for a long time, you are reading the market and what is the market rewarding. And while we have probably come back into a healthy balance in terms of growth and profitability, I think it is still true that there is a premium paid for growth. So M&A, when that premium for growth is more pronounced, then those companies are taking available dollars, and they're buying other businesses. I think that's particularly healthy for our ecosystem. And I think that things have been somewhat subdued over the last several quarters in terms of M&A, and I don't have a crystal ball, but I would suggest that is going to come back to some degree. Hopefully we're kind of coming out of that trough. And again, I don't know that is, I think some founders maybe don't pay enough attention to this because they themselves are not looking for or ready for acquisition or thinking about any kind of a public offering. But it is important because back to that whole cycle, it creates liquidity for investors. That liquidity gets redeployed, and and the smaller companies have an opportunity to grow because the investors can put more capital in. And the IPO, I think, kind of mirrors that. We've been stuck for a while with a number of really big private companies, and I do think that will come back to life a little bit, hopefully in early 2025 or later 2025.
Great. I think this is AI is on everyone's mind. It was a big part of the survey last year and again this year. Maybe just to kick us off, Blake, I would love to kind of first have you orient us around what is the difference between horizontal, vertical, and AI native SaaS, just so everyone kind of understands the definitions as best we can, and then walk us through some of this data, which is pretty interesting.
Yeah, I'll start with horizontal SaaS. So, many of the first SaaS applications, Salesforce, ExactTarget, et cetera, were horizontal software businesses that could really sell to nearly any type of company, and the product could work for nearly any type of company. And that was kind of the first wave of SaaS, right? Then we started to see a little bit later on the popping up of vertical SaaS companies. So those that were focused specifically on certain vertical industries, maybe one of the most famous examples being Veeva, that was selling to pharma and life sciences and is a very successful public company today. That was kind of the second wave where software was being more purpose-built. You could go deeper in a company's stack and provide more value with vertical SaaS. And then the newest wave and the one that we're in, and you just mentioned, alluded to, that a lot of talk and attention has been paid to it, is AI. And AI native is just really now starting to take shape. But you can think of it. Every company, I believe, is an AI company from here on out. You either have to have it built into your product, whether you're a horizontal SaaS company, a vertical SaaS company, or AI native. But AI native just is defined as kind of those companies that have AI at the very core of what they're building. And so it's not necessarily that they are vertical or horizontal. They can actually be either. But AI is the foundation of the product itself. And maybe just kind of continuing from there, Mike, this was really interesting to us. Maybe not super surprising when you step back and think about it, but as I was crunching the numbers in all the survey responses, this really jumped out to me in comparing the different types of respondents' companies and their various growth rates across the less than $1 million ARR band to the 1 to 5 million and 5 to 20. The growth rates were pretty significantly different. Horizontal SaaS lagging behind in those two larger ARR bands, vertical SaaS and AI native. So especially in that top quartile, as some of the commentary in the slide says, you look at the growth rates for AI native SaaS, and it's pretty staggering in terms of how quickly those businesses are growing. I'll maybe point out that not surprisingly, we didn't have enough companies in the bucket of greater than 20 million to be able to look at the same comparison. But in future years, excited to see where that might or how that might show up.
So what if I'm a horizontal SaaS company? Do I pivot and say I'm AI native now, or what do I do?
Yeah, Mike, I don't think that you have to pivot. I do think it's important to have a story. Do you know what I mean? If you're a horizontal company that has been around for a while, I don't think it's realistic to completely, scrap things and re-platform. But whether you're serving customers or you're trying to attract capital from investors, I think it is really important to weave into your future plan how you're leveraging AI, and for that to be a really intelligent and coherent part of the message, because the absence of that, again, either to a customer or an investor, is frankly gonna start to throw people off. So I don't think it's a panic and reimagine the whole company. I personally don't think that for most businesses that's wise, but I do think you have to make it a central part of how you're serving customers and trying to grow.
We had a good question.
Yeah, and Mike, this goes
go ahead,
back
Mike,
to your comment and question earlier about how to look at benchmarks. And keep in mind that the values that are shown here are the median and top quartile values. This does not say that there are no horizontal SaaS businesses that are growing quickly. So it's about finding product market fit and finding a recipe that works for your business, one that adds value, a product that adds value for your customers, and they're willing to pay for, whether it is horizontal SaaS, vertical SaaS, or AI. So it's kind of, keep in mind that while these are the median and top quartile values, there are businesses across all different types of categories that are performing at a high level.
I think that's super helpful, right? It's the context. A great question came in that's related to this. We'll get it out right now. Any theories as to why vertical SaaS is performing better than horizontal SaaS?
Yeah, I think that this has been emerging over the last couple of years, and really, I think it's the proliferation of SaaS into what we previously thought of as niche businesses, right? So if you go to G2 Crowd and you look, you will find, 15 companies, SaaS businesses that provide software for barbershops or arborists, or, I mean, and previously, nobody would either start or back a company that was going to be that narrow, because it was accepted that a horizontal business, a horizontal SaaS company would help you run your barbershop or your business that cares for trees. And that's no longer the case. The expectation of people running those businesses in those verticals is that they will have software that's purpose built for them. And if you can command enough of a price and the market is big enough, you can build a very big and very valuable company in a vertical. So, this has kind of changed over the last 10 years. And even when we started investing 10 years ago, we would, the bar to invest in a vertical SaaS business was super high, because we just believed that those markets were smaller, that those businesses were not going to spend a significant amount of money on software to operate their business. And today, really, the reverse is true. If you're running something that's in a pretty narrow vertical, you want purpose-built software, and you will pay for it because of the efficiencies that it's going to give you. So, look, we've got all this on one slide, and I actually think they're kind of distinct. I think AI native companies and how we work AI into our story as a SaaS business is really distinct from the idea that vertical is having a moment, and has really for the last couple of years. So I personally think this is really exciting. We're looking for vertical businesses. You still have to pass that test, Mike, that says you can build a big and valuable company, but the acceptance of that is much different than it was even just a few years ago.
Awesome. Super interesting. I think related to that, in my mind, you mentioned the G2 crowd of 15 plus competitors. And we take a look at this side, which is what's keeping founders up at night. Go to market, by far the biggest. I think you can have up to 3, but 76%. Maybe just to kick things off, Blake, I'm not sure, I'm going to put you on the spot a little bit. How does this compare to previous years in the survey, maybe most recent? Is go-to-market always top of mind for founders? And then walk us through maybe some of the other interesting data points you found while putting this together.
Yeah, so this is one of my favorite slides from the whole deck, the whole report. Go-to-market, as you asked, Mike, is top of mind every year. It was last year, it was the year before, I think it was the year before that. I don't think, as long as this question has been asked, that it's ever not been the top response. Last year it was 73%, so up slightly. And it's always kind of hovered around that or north of that 70% range. Maybe most surprisingly, this was one of those when we dug into the data that we're very interested in, was seeing AI strategy, because we just spent 5 minutes talking about AI on the previous slide, is the third from the bottom. And that was just kind of shocking to us. But one of the fun little discoveries you make as you're combing through all this data. So it was just super interesting to see that AI strategy was not top of mind. And last year it wasn't either. I think it was 11%. So those are some of the fun little nuggets. Maybe a couple other things that we discovered. We broke it down by ARR band, and when you look at that, earlier stage founders, maybe unsurprisingly, are much more concerned with cash burn. So that ranked quite a bit higher for them. And then later stage founders were really focused on finding or hiring the best talent. So as your company progresses and goes through those various stages, those change over time.
Awesome.
Hey,
go ahead, Mike.
There was I just saw that there was a question dropped in there. Justin, I'll kind of paraphrase your question, but with all of the systems and software tools and consultants and training that are available to help us sell more and better, how is it that this is still, go-to-market execution is still at the top of the list for founders? I think it's a good call out. It's not because people haven't tried to help and build systems. I just think this is, through the lens of what does it take to get your company funded, or what does it take to grow and not be dependent on anybody else. Sales still solves really most all of your problems. And so I do think that it is, I believe this is accurate, right? I really do believe that that this is a top concern by far for founders, because if you are hitting targets, if you are executing well on go-to-market, you're just afforded some grace. Other things can be at 70%, but if you're selling at 105% of your plan, you have the luxury of some time and some freedom to fix those. And I think most founders have just learned that is always going to be an issue. I was in a board meeting yesterday with a founder who is ahead of plan and is likely going to exceed their plan for the year. And he just smiled and said, all we're thinking about now is Q1. And, he's kind of laughing because he's not able to really celebrate much of what will be a good Q4 because it's coming right at him again in Q1 of next year. And I think that this data just reflects that reality that most founders feel.
Do you think if you were to take the label go-to-market execution and put product market fit there, it's the same thing, or is it different? It's more of a hypothetical, right? But like, if you think about like, what are my problems? It's like having a repeatable selling process in the right market with the right packaging and price.
Yeah, I mean, I do think that they're cousins, Mike. I think some founders, particularly product-oriented founders, talk more about product market fit because they have a confidence that they can read those signals, and if they're seeing the signal of product market fit, that what will follow is sales, right? That the go-to-market execution no longer has to be flawless. We don't have to get lucky to win deals. We've got product market fit, and an average seller, a new seller, a newly ramped seller can hit their quota and do well. In pursuit of product market fit, we're often doing founder selling, and we are tweaking our selling process every time. We're not ready to turn that over to someone else. And so I think they're related. In my world, product market fit happens in pursuit of really good go-to-market execution. It happens before that.
Yeah, Mike, I would say too that I think if I remember right, when I looked at this data broken down by ARR band for go-to-market execution, that was by far, in a way, the number one thing across all different ARR bands. I think if you rephrased it to product market fit, it might be quite a bit more prevalent as an answer in the earliest stages. And then as you get into the 5 to 20 million ARR, 20 million plus, that might be something that ends up a lot lower. So I think they're, as Mike said, I think they're related, but not quite the same.
Yeah, awesome. Thank you. Switching over to cash and cash burn. I think this has gone through some phases as well over the past decade. Blake, yeah, I would love to have you. I got a follow-up question, but I'll love to have you walk us through what the tea leaves say about cash burn, and I'll have a follow-up question for you.
Yeah, so this is one that I know founders are eager to see how other companies in their ARR cohort are spending money, and cash burn remained pretty low from compared to 2023, with some slight upticks, particularly among the larger companies in the data set, so 5 to 20 and above, where there is a slight increase. And this, I think, relates back to what we said earlier around those later stage companies that were able to raise money over the past year that were maybe more challenged with that. So as capital availability has become a little bit more prevalent in those later stage companies, they felt like they could spend and invest a little bit more money. But I think interestingly here, one of the big takeaways is that a company with greater than 50 million ARR, the median company is cash flow break even. They're in the mode of figuring out how to run a business that is break even or profitable at that size and scale. So I think that's noteworthy. But yeah, efficiency remains a big focus. I think we'll talk about this a little bit later on too, but that was certainly reflected in the cash burn figures.
Is this like the new norm or a temporary trend? Like if all of a sudden the markets open back up, M&A is happening, more dollars are getting funded, are we going to say, let's ramp burn back up?
Yeah.
And should founders listen to that? And then what happens if the market has a downturn and all of a sudden now I'm back to cash matters more than growth? Like how should I, like, where are we, like, in the phase in the cycle right now?
Yeah. Mike, I'll try to be real specific here. I think that founders, either with their executive team or maybe with their board, kind of depending on what their structure is, what I would like to do is build a 2025 plan that is pretty cash conservative, right? So depending on where you are in your cycle, you're either not burning much at all, or based on your balance sheet, you're not burning everything that you have. You're pretty conservative. And then I would like to challenge the team to say, what are the investments that we can make? What if we want to add 3 more reps? What if we want to come back and put 2 BDRs in place? What if we want to dial up our spend in event marketing? What if we want to spin up a second or a 5th pod around engineering? And really debate those investments relative to what they're going to do to your growth rate. That is, I think that's the right way to answer the question of should I be burning or not, is do we have the right investments? Have we vetted those? Have we debated them? And there's no right answer, okay? But have we as an executive team or as I said with your board, have we put those through the ringer and said, these are the 3 investments that we're going to make? And by investment, I just mean increasing your burn. But many companies either have not practiced that or got away from it when capital was more free flowing. And I just think it's the right discipline. And if funds come back and are more readily available, great. You've got plenty of things teed up in which you'd like to invest so that you can be more aggressive. But if they don't, you've got this relatively conservative budget that still has to, allow you to grow. But you're not back in the burn the ships, go everything for growth mode. And I acknowledge that that's a tough balance, but I think that's how a lot of high performing companies look at that challenge.
Yeah, I think pretty related to that actually is the rule of 40, which I think investors have it's been a metric some investors have cared about over the past decade. It's certainly become more in vogue in the last 2 years. And so maybe just to kick off this slide, I'm curious. So you and put on your early stage investor hats, right? Like, does this metric actually matter, right, to you guys as early stage investors, or do you care more about top line ARR growth, the market opportunity, the team? Like, where does it fit in the matrix of like all the other ingredients of what makes a company investable?
Yeah, Mike, I think that for early stage businesses, rule of 40 probably a little less relevant. You have to have some size and scale to, I think, really make an intentional decision to, dial the levers up or down between profitability and growth. One thing I'll point out though is if you look at the data here, 40 is a really tough bar in today's environment. The median values for all 4 of these ARR bands, none of them are really even close to 40. They're closer to 20. And then even in the upper quartile, there are only 2 of the 4 that are there in terms of rule of 40. So it's a really hard bar. And I think one important thing to note, and there's a lot of data out there about how the market values growth versus profitability. The market still does value growth higher. Rule of 40 is a nice heuristic and a very simple way to look at it that I think many folks can get their head around, because there certainly is a trade-off between growth and profitability, as Mike was, has been talking about already. But the market values, at least for public companies, growth at about 2.2 times how they value efficiency or profitability, I should say. So, for every 1% increase in growth, that's worth about 2.2% of an increase in profitability. So I think it's important to keep that in mind, that it is not, even though the rule of 40 is a one-to-one trade-off, when you're adding those numbers together, it's not quite the reality that you're operating in.
Yeah, I think that's super helpful. The one thing I did find interesting with the public markets too is those that have the rule of 40 to 60% are trading on a multiple of 11, and those 28 to 40 are trading on a multiple of 6.5. That's a pretty big difference.
Yeah. Yeah. And I think as you get to scale, which certainly the public companies are, that is a much more pronounced difference. If you're, looking at this chart, if you're sub $20 million, you have to be growing if your objective is to raise capital and be a top performer. And I think sometimes when we look at things like rule of 40 in small companies, we can confuse profitability and capital efficiency. What I was describing earlier in terms of figuring out where you're going to make those investments and how you're going to build off of a conservative budget, to me that's in the realm of capital efficiency. If you're under $20 million and you are growing fast and you're profitable, you probably are not going to need to go raise capital, even though you'd have an opportunity to do so. But for most of us, you have to be growing fast if you're under $20 million.
Yeah, and what I would probably recommend people look at those stages is more like, what's your burn multiple? How many dollars of ARR are you generating per dollar that you burn? And then what's your sales and marketing efficiency? How predictable is that? How efficient is it in generating new ARR per dollar that you spend on sales and marketing? So I think those are much better markers and things to pay attention to at those early stages.
Yeah, awesome. We're gonna keep moving because we got 10 minutes, and I want to make sure we get to some of the founder health. But before we get there, one quick slide I thought was interesting, kind of related to a lot of great content about net dollar retention and gross dollar retention reports. Make sure to check that out. Related to that is this mix of net new from new versus expansion. And going back to our cover theme of early stage founders, how should I think about, right? If I'm just getting started, I'm obviously selling to new customers. As I want to set myself up for success, how do I think about my mix of getting new revenue from existing versus net new logos?
Yeah, this is good, Mike. I'm glad that you picked this one to talk about. I think the story here for an early stage company is more about laying the foundation for a SaaS business that can achieve a triple-digit net revenue retention, right? Because as an early stage company, you don't, by definition, you don't have a big base to whom you can sell. So of course, as the chart shows, you're going to be getting the vast majority of your new ARR from new logos. But what you can do is you can think about how you structure your product and even how you do your pricing, so that when you are able going out for renewal and you're trying to renew these customers either on a monthly or an annual basis, that you have engineered into your product, into your offering, some way to sell them more. So for some of us, that's selling additional seats. It could be usage based. It could be output based, which we're seeing a lot more with kind of AI native companies. And so there's a host of things you can do, but have those conversations early. Have them with your engineering team, so that you're building into the product the roadmap that says, is this a new feature that gets thrown in to help us win a deal, or is this something new for which we can charge? That's how you grow your net revenue retention. And I think that is a metric that has a lot of staying power, Mike. So whether we're talking 5 years ago or 5 years from now, if you have very strong net revenue retention, which I would put in the triple digits, and best in class is going to be up 120, 30, 40, 50%. Those companies are highly, highly valued. If your net revenue, if you have not thought about this, if this is an afterthought, and you don't have anything else to sell your customer that can drive a net revenue retention number up, it is difficult to retrofit. You can do it, and you should put time into it, but it's difficult to retrofit a business for net revenue retention. So I actually think this is a really pertinent slide and topic for early stage founders.
Yeah, awesome. All right, new to the report this year was some great content around founder health. I guess my first question is, why did High Alpha decide to put an emphasis on founder health for the first time in the report this year?
Yeah, I'll hit the why, and then Blake, I think, can help us step through kind of what the insights are. Mike, this is the broad idea of founder health, and then the 3 areas that we chose to go into today with stress and exercise and sleep. I think we're just big believers that this is a conversation that needs to happen kind of out loud. It needs to happen among founders. It needs to happen between founders and investors. So just trying to shine a light on this is important. We talk a lot about this on our own team. We talk about it increasingly with founders. I think it's a very good development in the world of venture. And so we was important to us that it have prominence in the survey. And I think it is something that we'll continue to look at and study, so that if nothing else, we're letting people know that these are important questions, and that they're things that they're feeling or experiencing are likely being felt and experienced by a lot of other people. So, Blake, you want to hit a couple of things that the charts are showing us?
Yeah, absolutely. So I think it's important to, as Mike said, I think just shedding a light on some of this data is really the main goal, especially in year 1. It will be very interesting to see as we take this forward in years 2, 3, 4, and 5, how and if this does change over time. But looking at these couple charts, it's maybe not too surprising to see that as growth rates increase, in the chart on the left, where founders, companies that are growing at 50 or 65% year over year are really stressed. So I think that just knowing which bucket of those you're in, and kind of how you're feeling, and knowing that there are others that are there with you is important. But I think it's also good to remember that the conclusions that one might draw from looking at this data is not necessarily causal. Where in a maybe a little bit of a silly example, someone who feels very stressed, that then their company will grow faster as a result. I mean, I think we can all guess that it's probably more the other way around. But just some interesting insights, and we were eager to expose this data so we could see what people might learn from showing it. The chart on the right's financial security, where again, maybe interestingly, or a little unsurprisingly too, companies are growing faster in general. Founders felt more financially secure, and those that were growing slower felt less financially secure. That could be sacrifices that they were making around their base salary to help support the company and keep it going. So a lot of reasons probably behind that, but we were just excited to get this data out into the world and see how people react and respond to it.
Yeah, so here's a good one on exercise too. So what you're saying is, if I don't exercise, I have an AI native company and I'm super stressed, it doesn't mean I'm going to grow fast.
We're definitely
Yeah,
we're definitely
okay.
not saying that.
Yeah, all right.
We would like to talk to you, however, but no.
Yeah. So we have an awesome slide on exercise, and I'll wrap with sleep and just make sure you have some time for questions. I'm wondering, we should ask Jeff Kahn, but if this maps just like how much people sleep too, it'd be kind of interesting and looking at that benchmark data. But anything interesting with sleep that you found, Blake?
Not necessarily. Nothing in particular. I'd say I think interesting to see is actually probably a little surprising for me to see that 39% are in the 7 to 8 hours. I thought it would actually be a little bit shifted to the left on this chart. I'm kind of curious as to who the 6% of founders are that are sleeping more than 8 hours a night. Maybe our friend Jeff is, but no, it's I think again, this is a scenario where regardless of whether you're in the 5 to 6 hour bucket, 6, 7, 7, 8, there are other founders like you, and people all have different kind of priorities and motivations for why they're doing what they are, what they're able to do. So hopefully, as I said before, this is insightful data as we begin to look at trends and pick up on those types of things.
Yeah, fantastic. Well, thank you guys so much for spending an hour with us in the Visible community, and thanks everyone. I think pretty much everyone stayed on the entire time, which was awesome to see. We're gonna make sure everyone gets this report. We usually get a question about if this is recorded. It is, so that will be included. You can get the report right now if you go to SaaSbenchmarks.com. But thanks so much to High Alpha, to Blake and Mike. Thank you so much for spending some time with us and walking us through the data this year.
Thanks, Mike. Appreciate it.
All right.
Good to hear.
All right.
Thanks so
See you
much.
guys. Bye-bye,
Thanks,
everybody.
everybody. Bye.